What's up, guys? It's Ron from Ronald Law back to you with another podcast episode. And I'm really excited to have George Pino. He's a broker, he's got his own shop, Los Angeles market, or would you consider nationwide now?
Nationwide. I actually, what I specialize in single tenant net lease investments. I do nationwide. I've been able to sell in 30 states. And then in addition to that, we have 27 affiliate offices that allow us to transact.
Awesome, awesome. Well, I really want to discuss more about, what's going on in the market. What are you seeing on the investment sales, both from a supply perspective, on that single tenant net lease, there are tons of units coming on, but we're not really seeing cap rates expand much. So it's kind of an interesting situation, right? The days on market, there's 14 months of inventory of 7-Elevens, but the cap rates aren't really coming up. Maybe Starbucks is finally creeping up there if it's, not the new footprint. But talk us through like your overview of the market right now. What are investors doing? What should they be doing?
Ultimately, a lot of investors are sitting and holding. And we saw transactions year over year from this STNL market, or actually investment sales in general, dropped about 60%. We're starting to see it pick up right now. And, part of that is there's a lot of equity that's been sitting on the sidelines. A lot of people who are using debt for their acquisition or investment strategies have been sitting a little bit more on the sidelines. We're seeing still activity, a lot of with the cash buyers. They're still out there. They're still around. It's just that a lot of the debt buyers have kind of pulled back a little bit. But we're starting to see that come on the market now as lenders stuff. We have different lenders. Traditionally they've been tied to the 10-year treasury, and we're now seeing a lot of lenders tying to the 5-year treasury. Overall, though, investments, we have, as you said, a ton of properties coming on. That being said, the sales are not keeping up with it, so the inventory's there. So I think if anything, it's a great opportunity for buyers to pick up an asset that is traditionally may have a lot more competition going up against. Some of the sales that we've had this year with my clients, a lot of them have been trophy type or trophy style location assets that we're able to pick up at some amazing cap rates.
So give us an idea though. What does the tenant roster kind of look like? Are you more on the fast casual, the dining side? Are you doing convenience store? Like what when you say within STNL, what type of tenant mix pool are you looking at?
For me, majority is QSR. It's going to be your the fast food, fast casuals. At the same time, we're still seeing a lot of the C store, especially now with the changes with the one big bill made, extending out the bonus depreciation. So we're seeing a lot more of the gas and C store type store units come up for sale. And that's also been a lot of interest for a lot of investors as well.
Do you think those C stores have bigger rent bumps than other QSR, like the Taco Bell or something? Do the C stores have a little bit more business dynamics where those operators can really have a plan to increase NOI?
Well, it's as far as the operators boosting NOI, absolutely. There's a lot of different changes, and we're seeing a big change in the C store landscape itself. Now, as far as rent bumps or growth, rent bumps are pretty much standard across the board for the most of the corporate STNLs, where you're seeing anywhere from 8 to 10%, sometimes 12% every 5 years. Every now and then, you may see a older type lease where you're seeing annual increases, but that's rare. Usually it's on a 5-year term. But going back to your question on the C stores and what's happening there, there's been a big change in the last, I'd say, 5, 7 years in overall gas C stores where they're actually offering a lot more food items. So, 7-Eleven, for instance, you mentioned them earlier. Um, about 10 years or so, they acquired a company called Stripes down out of South Texas. And one of the main reasons they acquired Stripes was to actually get their brand Laredo Tacos, which Stripes had Laredo Tacos in almost all their locations. So it allowed them to pick up that concept and start rolling it out. So now you're seeing 7-Elevens on with large footprint C stores that are 5,000 plus square feet, nowhere near a Bucky's, but getting there. So, but you're 5,000 square feet, but they actually have a fast food quality restaurant inside. And in some locations are actually, you can go in there and order a beer on tap, and things like that. So they're adding that in some parts of the Southeast. They have roost chicken that they're adding in. So there's a lot of room and growth in that. And we're starting to see that with, one, there's always been a consolidation in the C-store industry, whether it's with Cartouche, with Circle K or 7-Eleven, Southland Corporation just gobbling up some of the smaller companies. And we're starting to see that had slowed down in the last few years, but we're starting to see it pick up a little bit more again, where Cartouche has stated that they want to really expand even more so. In fact, they made a run, for 7-Eleven. Of course, 7-Eleven wasn't offered for sale. They just said they'd buy it.
So it's very interesting. When we see industry consolidation, typically for the landlords and investors, that's a bad thing, right? It creates more tenant power, it gives them more leverage to negotiate, and the investors, the landlords typically pay the price because they have fewer options at renewal and stuff. Do you see that impacting values today, or are people not worried about that yet?
I think people aren't really forecasting or seeing it at this time yet. And, ultimately, although a concern, it can be navigated if done correctly. And, it really goes back to the main rules of investing in real estate, and that's location, location, location. You can take all the leverage away from the 800-pound gorilla if you have the only location that they want to be at, or the best location that they should be at, or a location that they want to keep a competitor out of. So,
Yeah, interesting.
and that used to be the old Southland model where, 7-Eleven used to never close locations down as long as they made a dollar. It wasn't so much about how much money that location made as if that location was profitable. Well, if it's profitable, I can maintain it and keep it open, and that keeps all my competitors out of that market. So, I mean, that's a strategy, business strategy that some companies have used. But as a landlord, you can kind of use the same strategy by just picking trophy type or going down, delving into the location itself. Like, why is this location the best one?
Well, I mean, so look, 7-Eleven has done really well. They're the neighbor here. I'm in Dallas. I know a couple of
Mhm.
people in the real estate department. I've been trying to get them on for an episode. They keep having to run it by corporate, but I'd be really curious to ask them what's in the pipeline or what do they want to do. Because one thing that they are trying to do is expand into more industrial areas and get into the
Mhm.
trucking fuel, because that's a good example of people that are stopping for fuel really frequently. Their C store options are such low quality that they're not spending money there. And if they can combine those two, that's what I've heard. And this is in the past year. They're really trying to get into that truck driver, kind of the diesel fueling game. But yeah, they're a really cool company in terms of what they're doing and being successful at driving that margin, getting people inside, right? Get people inside to spend money, and then they have the great operations and
Yeah.
margins inside the store. Well, that's cool. So if you see a 7-Eleven, it's a good buy. They're expensive though, right? Aren't they like 5-7 million? Or
The newer concept store locations are because you're typically at a much larger land size and you have a much larger footprint for for both the canopy for the gas. So there's more gas, actual uh, pumps, but also you have a much larger C store, which is traditionally you're looking at about 2,500 to 3,000. A lot of these C stores are 5 to 6, some even 7,500.
so what kind of listing or asking prices for that new footprint?
The new footprint, you're looking at that 4 to 6 million range right now.
Okay.
Now, some of the older ones, especially if you find some of the older locations that may not have a gas attached to it, but a really strong C store location or so, those can go as low as $1 million or sometimes even less in tertiary markets, which I wouldn't necessarily recommend. I mean, I tend to stay away. My whole business model for investing with both myself as well as with my clients I work with is all about location. Find the location. I'm not as concerned as the tenant as much as the replacement opportunities. Meaning, a lot of the clients and properties that we've sold, the best option is if that tenant were to go out of business.
Interesting. Yeah, that's a great downside protection. If your cash on cash yield, today kind of makes sense, but even if it's a weaker tenant, buying the location now makes you more money in the long run. So
Absolutely.
that's great. Well, tell us. I guess that's a good segue. Tell us a little bit more about the investor profile, because you're not just dealing with 1031, right? I know a lot of the single tenant guys just 1031, that's what they go after. But what does your typical client look like? Are they 1031? Are they real estate investors full time?
We have a lot of 1031 clients, but a lot of that we use is actually clients that we use that strategy more. It's not that they come to us as a 1031 client. We actually, a lot of it is repositioning assets. And, if you're repositioning an asset into another asset, then of course, you're going to want to 1031 that to avoid any capital gains or short-term capital gains tax on that. So most of my clients, I have about a 50-50 mix. When I'm working with a client, the first thing I do is find out what their goals are. And then I try and find out with that, we're going to try and find and match the appropriate type properties, whether they're looking for straight cash flow, asset preservation, whether they're looking for appreciation plays, whether they're looking for repositioning one asset into another to increase cash flow, perhaps increase their basis for depreciation, things like that. So we're taking all that in, and then we're actually creating a full picture, just like institutional investment company would, where I would come in and say, well, here's our acquisition, here's the estimated time to acquire it or to sell it if we're repositioning, here's what we're looking at for the time frame to acquire new properties, here's how you're going to hold it, and here's what we're going to do at the end of that hold period to either increase the value, to get it to sell, to turn it into another asset. Sometimes I do have clients, not too many, but that like to set it and forget it. They're traditional STNL 1031 buyers that, just bought something and want to forget. For instance, one of my better clients, I worked through a portfolio of about $40 million in real estate in Los Angeles submarket, a mix of retail, multifamily, and a couple others. And she wanted to go into something a little bit more passive and wanting to get a little bit more income and really more retire because she was actively managing all of that. So we structured everything, and it took us a period of about 4 years to sell all her assets and replace them. And we also worked with her accountant and her attorney to actually increase basis by about 50%, increase actual current cash flow by about 30%, increased income by about 32%, but overall cash flow actually increased post-tax benefits by close to about 38%. So that's what we're looking at. One of my truths that I tell my clients, and this is how I look at my investments, is that my investments are investments. I'm buying them. I may have no intention to sell them. However, if I get a good offer tomorrow, whether the market's down or up, I'm going to sell it. My main metric when it comes to selling an asset or buying a new asset is, if I sell this property, can I buy something that's going to perform better? And when you look at it that way, and you look at it as, especially if I'm doing a 1031 exchange or something and I'm not taking cash out, it doesn't matter. I don't have to time the market anymore. Because if the market's down for my asset, yes, I may be getting less than what I purchased it for, but I'm buying a better property for less than what I could have bought it for also, because the whole entire market's down. And as long as new property is outperforming my current property, I've done better, regardless of whether or not on paper I may have had a loss.
Yeah, no, I think that makes sense. And when it's a down market, maybe you can step into a bigger property at a bigger delta in terms of a discount, right? Because you
Exactly.
forget, if you only sell in high markets, the assets you want to buy are also high priced.
Exactly.
So you want to
Exactly.
probably take the bigger swing when asset prices are down across the board.
Yeah. So we do that. We do a lot of studies on tenants, upcoming tenants, brands, things like that. For instance, 8 years ago, one of my favorite brands to sell was Raising Cane's. At that time, my clients were buying them for 6.5 caps plus. New construction, great 20-year leases, great, amazing locations. This is before they really exploded, but we were watching them. There are certain metrics I track when it comes to the health of a brand. When I'm looking at AUVs versus their rent to sales ratios versus their product line, and also what the trends are within the market
Sorry,
itself.
will you just say out what does AUV
Oh,
stand
I'm
for?
sorry. Average unit volume. For instance, Chick-fil-A, for a company that is only open 6 days a week, has the highest average unit volume of all fast food locations at about $7.5 million a year in sales. They're followed immediately by Raising Cane's, and then you have actually In-N-Out has made a big push, and their AUVs are up to about $5 million now. Historically, they've been at 3 and below 3. So when I see a company that is growing, that may be in that 40, 50, 60 unit size range, but their AUVs are killing it. Average McDonald's AUV, they are the largest chain, is still slightly above $3 million. So if I'm seeing average unit volumes of a new concept that across the board are in that 4 million range, and they're growing and they have investor appeal, all of a sudden I'm targeting those for acquisitions, because I know in about 3 to 4 years, that 6.5 cap rate property that we bought for the Raising Cane's, we're able to flip out at 4.5 caps.
Right. Right. Well, yeah, McDonald's is interesting, right? Are those able to be purchased, or and if so, when? What are the scenarios?
You mean McDonald's?
Yeah, because I thought the big mantra was, at least when they started, they had all corporate owned real estate, right? They were a
Yeah,
real estate business that happened to have a captive operator.
exactly.
McDonald's do come up now. What are the scenarios?
They
Are those
do.
good
Well,
buys?
typically, McDonald's likes to do a ground lease. That way, they get the depreciation benefits of the construction of the property that they're building on that property itself. From there, McDonald's is still very much a real estate business. They'll come in as the 800-pound gorilla, negotiate a ground lease rent at 100,000 a year, triple net. And then what they'll do is build the location, build the space, and then they arbitrage it and lease it out to their franchisee for 180,000 a year. So they're making money on the delta of 80, plus on top of that the franchise fees, plus on top, plus plus plus. So still very much a real estate model. People love them. They are definitely a good set it and forget it type of asset. It's hard to create value on a lot of them because they trade at low cap rates, just because of the panache or the mystique around McDonald's being the giant McDonald's, who they are. So because of that, they tend to trade at low cap rates.
And do they tend to trade in like larger portfolios? Because even if that's at a low cap rate, I feel like the absolute dollar amount, do they trade as individual ground lease sites, or are they more bundled as part of a portfolio that, they don't come up that frequently because they all trade together?
Both.
Okay.
Both. Usually the bundled sites are usually going out to institutional investors, and that's quietly on the market, or very quietly. Sometimes no one's even aware of it until they announce it. That's where you may see potentially upwards of hundreds of units at one time being sold.
Wow.
And at other times, though, and then a lot of times from that investor will then spin off sites that they don't want, and they'll do that individually out to the secondary market. So again, and or potentially arbitraging cap rates, meaning, you know, I've had clients that have purchased portfolios and then sold off some of their better ones at lower cap rates to average out and bump up the current cap rate on the other assets that they own for cash flow plays. So there's different ways to go about that and different strategies to utilize. You just need the right person to kind of walk you down that path and help guide you depending on what your
For
goals are
sure, for
trying to
sure.
accomplish.
So let me ask you this though too. If you were starting off now, and let's say you like the single tenant net lease space and you like the QSR world and these types of analytics, how would you do it? How would you buy and sell these as a way to make money? Because everybody knows the value add in multifamily, everybody knows value add in industrial. But with these single tenant net lease, how would you structure it to make money? And can it even be done if you wanted to be some type of GP or sponsor?
Absolutely. For instance, I have an asset right now that we have acquired, but we're repositioning. And it is in the inner loop of Dallas, high profile, good location. It was a bank. During escrow, we found out that bank was going dark, even though they had 9 years remaining on the lease. Because it was going dark, we were able to negotiate a little bit better sales price, higher cap rate of risk versus reward. But more importantly, I'm sitting there looking at this like I have a acre roughly of land on the 12 inner loop of Dallas, and I
Is
can
there a
retail.
drive through? You have an existing drive through?
Well, it's a bank with a drive-through, but right now I have an offer on the table that we're very close to inking out and doing. But the nice part was, because I knew I had a lease on there for 9 years, I also knew I could take my time and handpick my tenant who I wanted to go after. So we have an offer on there right now for a great ground lease that's going to replicate the 100% of the rent that we have coming in from the bank. More importantly, on the TIs, they've only asked us to scrape the building, which I'm going back to the bank and I'm going to ask them to scrape it for me. On top of that, the bank is offering a buyout that is just under seven figures for the remaining term of their lease. So I have that coming in, I have this coming out. So immediately I'm going to be able to get about a 40% return within 3, 4 years of this property.
Okay.
So 40% overall from the acquisition price. I think that's a hell of a return. That's really good. There's also another property that uh, we acquired, and it is a trophy asset. It is in the number one super regional mall in the state and actually in the region. Even if you have a good tenant and that's strong, if you know what you're doing, you can then reposition that lease to create that value. And, for instance, on this property, that's exactly what we're going to do because it's such a trophy location. We know they're going to want to stay there. So we're going to offer some concessions to get a brand new lease, but we're able to go into this at a great cap rate because of the shorter term remaining on the lease with also with rent to sales ratios. I know they're not going anywhere. The store's performing really well. At the same time, worst case scenario, if for whatever reason the entire company goes bankrupt, that's a good thing for us because I can bring somebody else in at an even higher rental rate as opposed to repositioning the lease.
Nice.
So there are
Yeah.
ways to actually increase and create value if you know what you're doing in the single tenant net lease market.
Yeah, because I think I see that a lot. A lot of the value add kind of comes in vacancy risk and buying dark ones, maybe putting some TI or putting it in front of the right ones. And it is a little bit risky, but maybe, what you're describing, you have to have a lot of expertise just to negotiate within the existing tenant. But I think what your kind of story shows is they're always willing to talk. I feel like they all have dedicated real estate departments and they will talk to all their landlords, just at least to hear them out. And so you have an opportunity for value add without taking necessarily vacancy risk. But even if you do have vacancy risk on a $1.6 million building, the hold costs are nothing. I mean, no offense. It's like for me coming from like a $3 or $5 million industrial building, even multifamily guys, they don't want to take vacancy risk because it's costing tens of thousands a month. Your hold costs on that little thing are single digit thousands for 6 months, and you're like, okay, I potentially could reposition, or maybe you gamble with a near term lease because a vacancy doesn't scare, or financially it's just not as much of an impact.
Absolutely. And you can mitigate that a lot of that risk for vacancy loss by just choosing the right locations. For instance, one of my clients bought a Chase Bank that catty corner to the new Dallas Cowboy Stadium. Best case scenario, that bank, Chase Bank, goes away because I can get a C store or anything else in there. I get 7-Eleven in there paying more rent.
Yeah, I mean, you just tell 7-Eleven Wawa reached out. They want to plant their flag here.
Surprisingly, in this market, that's actually one of the better ways. When we talked a little bit earlier, you talked about how some of the larger clients or tenants, they come in as the 800-pound gorilla, and part of that strategy is to keep other people out of the marketplace. But as a landlord, sometimes that could potentially backfire as well because that's what they're trying to do. When it comes time for that lease renewal, sometimes you can use that against them. I just helped a client with a lease renewal for a property in Oklahoma that happened to be a Starbucks. Well, Starbucks, of course, when they're coming up with the lease renewals, they're claiming that they're having a hardship.
Well, look at how many locations did Starbucks close? I mean, it was pretty massive.
Absolutely, absolutely. But here's the fun part. So with a lot of the tools that we have, we pulled up all the traffic counts, actual visits, store visits. I'm looking at this, and this is in top 10, 15 percentile in the entire state. And then I compare it to rental rates of what they're paying for other locations that have visits that are half the amount, and they're paying more in rent. So I know that they're just bluffing.
Wait, you mentioned some tools. Are you using Placer.ai, or what other are you doing cell pings?
There's Placer.ai, there's Retail Sphere, there's a few tools that are out there that do a fairly good job at identifying and looking at traffic, and depending on how you use them, and I mean, none of them are perfect, but
Yeah.
you can definitely utilize those. So absolutely, yeah.
Do you think the precision is accurate enough if you're like inline shopping center versus out parcel visits versus larger, like a academy or something? Because that's one thing I've heard is that the pings, the frequency of the GPS is not as accurate. And if you have inline shopping centers, you actually can't really tell what store they're in. If, these are small strip center, right? So like if they're right next to it, it's kind of hard to tell and you don't get good data. Obviously, if it's an out parcel, you can kind of extrapolate that, hey, they did park here and they did go in, but you don't necessarily know if it was drive through or sit down, and that might change their average check size. Like, how much do you dig into this data other than just saying, we know your visits are high? Do you actually go out to try to calculate?
Well, you can actually calculate it, and there are certain tools and certain companies that will actually calculate. What you're doing is when you're calculating visits, and to your point of, yes, a drive-through versus sit-down may be a little bit different as far as the purchase points or the average ticket price. But at the same time, if you use the averages, that like what's the average ticket? We talked about AUVs, average unit volume, average ticket price is what the average person spends on each order.
Okay, so if you use average visits times average ticket, it doesn't matter if it's drive through or sit down because the average
Exactly.
will still average. That makes sense. Okay.
Exactly. So we're using those numbers, but at the same time, when it comes down to the details, it is getting better. And there are companies that do different things. Like for instance, Placer.ai, they use the main thing of the AI is that the cell phones that they're tracking, they're not tracking 100% of them, but they're using AI to extrapolate based upon how many people are in the area, how many people have signed up for their service, for their location service identification versus how many are out there. And to answer your question, how reliable is that data? There have been very large companies that, let's say you walk, and you probably know of a couple of them, especially if I say you walk in and there's a 78-year-old man with a clicker going 1, 2, 3, 4, counting how many people are going through. There are large companies that have gotten rid of those people because of Placer, because when they did side-by-side tests, the numbers differential was inconsequential or within the estimate, within the errors that were allowable.
Yeah, no, that's what I've heard is that, for as much as we care about privacy and like, trying to shut down our phones, all it takes is one permission, one app that slipped through the cracks, and then boom, they've got all my data and my location. Even if I'm religious about no, 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 not track, not track, one of them gets through, and boom, they get my location, and that's what is being sold. And personal privacy issues aside, it is very accurate. And if they have your location, because that's what I found, and this is the tip for industrial investors, use that data as a similar proxy. Because while we don't necessarily have a retail component of sales, activity is an indicator of a good industrial site. So
Mm-hmm.
if this guy tells me, oh, we're not busy, we're not doing this, I'm like, well, but you're not any busier than you were 3 years ago, and you had the same number of trips, you had the same number of employees coming in and out, and the activity traffic is the same when you did a renewal, or you said things were going good. And so whatever it is, I know our numbers might be a 10%, a fraction of a QSR, but it's all relative to the business where it was 10 years ago. And I might not even own the building, but relative. And then they might say, oh, it's seasonal. Oh, we're having a slow Christmas. Those numbers I'm like, okay, well, Christmas to Christmas last year, you guys were the same. Whatever their answer is, I feel like this data is an incredibly powerful tool for landlords. As long as we have humans with cell phones visiting the site, then we're useful. Until we have Tesla automated trucks, delivery trucks with automated pickers that they don't carry cell phones on them, then we might be at a loss. I think traffic and visits and duration and unique IPs visiting is so critical for a landlord.
It's pretty amazing, and I think we're even seeing it change and evolve. The nice part is my business partner and I, we've been approached by several different AI companies, and we actually consult and talk to them about like how they're competing against either Placer, or they have a new concept and they're coming in, and I'm like, oh, have you thought about doing this for the brokerage community or for the landlords? And even Placer, the way it's used nowadays, I mean, there's so much more opportunity potentially. Like for instance, I don't think people delve enough into the traffic flow pattern in Placer. Not only do I know how many people visited, but more importantly, I know when they visited, where they came from, and where they go to afterwards.
Yeah,
So
super.
If I know they're going home afterwards, I can fire change or go after certain types of tenants along that way if I'm the landlord. So it allows a lot of insight for a landlord to be able to create synergies within the center itself or within that unit or property, or to, hey, here's who is going to be the best tenant and here's why. I think that there's so many opportunities that are out there that just aren't being utilized yet, and it's all data driven. I mean, that's the new thing. It's all about the data.
Yeah, because
Well, I don't
the
know.
castle swipes for office users, they look at the badge
Yeah,
swipes,
yep,
but
the
that's
badge.
such a yeah, sure, it's a useful metric and percentage occupancy and visitors, like we get it, but it's such a small tip of the iceberg of everything you described. The badge swipes alone is like, well, yeah, that's cool, but we could get so much more. And I think as an investor too, if you could tell a buyer, my average commute time is 15 minutes. My people are coming from a very short distance, and I'm a powerful thing, because if people are commuting from Plano, they may not want to renew their lease. They want to look for something closer, that sort of thing. So it's really fascinating, the stories you can tell with a lot more data and interpretation of it.
Yeah. Yep, and it all boils down to either risk mitigation or opportunities created.
That's right. That's right. Cover your downside or push for upside. Either one. More data will help you make that decision. So I think that kind of ties into my final question. And what's kind of your future predictions for single tenant net lease? Are we going to see cap rates go back into the threes and fours, and twos for ground leases? That was some of the lowest I saw. Maybe there has an imminent rent bump, but like, what's your prediction for a single tenant net lease? If somebody's listening to this and they're an industrial investor, should they look at this as a compliment? Should they go all in? Should the multifamily guys come out, or what's your take on the future?
You know, uh, Number one, I'm a firm believer in history. So, single tenant net lease has historically been one considered the most liquid of all real estate asset classes because there's always a buyer pool behind there. It also typically is the one that is most affected as far as pricing wise with the bond markets and whatnot. There's a lot of fluctuations in that because you're buying not just the real estate and the property, but also buying into the business and the cycle of that lease term. There's a lot of moving parts in it. Now, is it going to go away? No. I think if anything, you're probably going to see a lot more interest coming up. There are many benefits for single tenant net lease that when it comes out and people start talking about it, yes, there's a risk of vacancy risk of, the tenant goes out, you're 100% vacant, but that can be mitigated pretty easily. When you start looking at other aspects of the single tenant net lease, so there are so many ways that a client can increase their cash flow, look for more passive cash flow, look for depreciation. Some of these tools are not offered with almost any other asset class. I don't see it going away. I think it's always going to be part of the market. Now, as far as the demand goes, are we going to see those two caps? Probably not. Three caps? No. I'm old enough to remember interest rates in the teens.
All right.
So when people are complaining about a 6-7% interest rate being high, I'm like, I remember in 2002 when it hit 6%, and everyone was like, ooh, it hit 6%. Wow. So we've had a long period of unusual low interest rates. This is not typical. Right around COVID or so, we had the prime. It was the lowest it's ever been in history. And historically speaking, we're talking about an index that's over 1,000 years old. We have to look at it in perspective. Is it going to be here? Yes. Are we going to see those two caps, three caps? I mean, yeah, you're probably going to run into some high three caps, mid three caps on certain trophy assets with the trophy tenant, brand new lease situations, new construction. You're going to have somebody that's going to be willing to put money into that. But generally speaking, we're going to see a little bit more of a normalized cap rate, probably falling anywhere from 5 to 10, depending on the tenant base and who they're at.
Okay. All right. Well, there you have it. I mean, I appreciate this, George. It's a really good primer on kind of what to look for if you're underwriting single tenant net lease. And I love you showed the way to value add without just pure vacancy, just not the simple model of buying a dark building and placing a tenant. Everybody knows that, but it's pretty scary. It's intimidating if you're an investor that's new to the space. So just reworking the lease is pretty cool. As a great way. Again, thanks for tuning in. Well, I'll drop that link for the YouTube channel and email if they want to reach out to you. If you guys are a broker, investor, definitely reach out to George and he'll take care of you.
Great. Thank you, Ron.